Let's say you have $1,000 and you have two options. The first option is to buy two Grace corned beef and broth later, or the second option is you can just invest $1,000 into the Grace Kennedy stock that appreciates 10% in value every year for the next 5 years. Which one would you choose? By the end of the 5 years, these lovely corned beef would have been forgotten, and this $1,000 would have turned $1,610.51. In that short example, that's the concept of time value of money. But let me explain more. Time value of money is a fundamental concept in finance that states that money is worth more in the present than it is in the future. This is because the money can be invested and earn interest over time. So basically, in a nutshell, the longer you wait to get the money, the less in value it will essentially become. Alright, so for example, let's say I offer you $100 today or $100 1 year from now. You would likely choose to receive the $100 today because you could invest it and earn interest over the next year, making the money you receive today worth more than the money you would receive in the future. Time value of money is a very important concept to understand because it is used in a lot of financial calculations, some of which are to calculate the present value of future cash flow, the future value of money, and the internal rate of return. These calculations are then used to calculate the value of an investment or calculate even loans, among other financial stuff. But to understand it more, let me give a more in-depth example. Imagine that you're offered the chance between receiving $100 today or $100 1 year from now. If you choose to receive the $100 today, you could invest it in the stock market that, let's say for this example, earns 15% per year. After 1 year, your $100 investment would have turned $115. So it's better you take the money now and then invest it rather than wait 1 year later to get it. And to calculate simple time value of money, you can even do this on your phone. So the formula is initial investment multiplied by 1 plus interest powered by the amount of years. So basically in this example, the initial investment would have been $100 multiplied by 1 plus 0.15 powered by 1, and then you get the $115. In contrast, if you're supposed to receive the money in year 5 or year 6, you'd likely choose to receive the money in year 5 rather than year 6 because, as I said again, you can invest the money and grow interest on it. Not to mention the fact that each year inflation also eats away at the real spending power of your money. But that can be for next video. But I want to show you two concepts in Excel. Alright, for me. So this is a simple Excel sheet. I did it two ways. The first way is just using this formula, which is the one I expressed on the video. So let's say, for example, let's say we started investing and we start invest regular account start with $100 at $10,000. So we're going to start with $10,000 invested, and let's say we invest in a company. Let's say the interest the company grows is say 10% for the year and 1 year. So basically make $1,000 on your money because see there it is $11,000. But let's say you spread it over say 5 years, then you end up making 16,000 mash. This is compounded interest right here. So guys, the 10% and 10% balance and 10% balance, because if I just did 10% straight, you would get $15,000 roughly. So end up get like an extra $1,000 for the 6 years. And then if you put it to like say next 10 years, it's going to be 25,000, etc. So basically make 15 grand, call it 16 grand per money. But the trick is, whenever you're investing, and people typically say, oh, when you're investing, don't just invest one time, because if you're investing at 10%, you have to get 10 years to make 25 grand. And yeah, it might seem like a lot, but we'll put back to 5, so put it 5 years, and we have that. So 5 years will only make $6,000 money, and $6,000 is not really enough money for, like, make you retire. It depends on the after them things. So what I did, I created a second Excel sheet which is the compound interest with monthly payments. So basically, is this just added an extra column where you have the payments, as in like regular payments. So you decide from a predetermined time how much money you're going to invest per, let's say, per month or per week, and so on and so forth. And some cash from amortization schedule it, come to get graded, and yeah, more get graded, and then but I think so you can tell me guys after. But yeah, so say we'll use the same information. So 10,000 at 10% 5 years, same thing. So add more 0 on this, 10,000 at 10% for the next 5 years. The thing is, you're going to get the same figures. You see me? Because it's after I do the second one, mess with. All my figures put 0 for the payments, and then you get the same thing. So 0 for the payments. If you put 1, then you barely get much. So let's say we put $10,000, and every year we're going to put $5,000 to it. So every year put $5,000 to it. Put $5,000 to it. Then yeah, if see if every month we're investing, we compound and compound and compound and compound, and yeah, let's say, and this is every year. So what if we start off with 10 grand, but as time progresses we end up having more money? And if I put a calculation for like if it's monthly or whatever, it's just a simple example to show you guys. But can just go some quick equal 5,000 multiplied by 12. So this I gonna show, this formula is basically just saying you're 12 months in a year, and every month I put 5 grand. That's all it do. I think if you guys want, we can do updated version of it, but I'll send this in the Telegram group so you can check it out, and then you can play around with it if you want or so on and so forth out in time. So you see, basically you start with 10 grand, and for the period, like every year you're investing $60,000. Is just add the commas them set speed to say currency. We're going to add this to currency as well. So see there for the 5 year, for like every year you invest $60,000. And if you want to do this, I think you can just do the quick calculation. All the money you've invested is $300,000. Just don't show you the calculation. It's $300,000, but at the end of the time, because of compound interest, you basically make like $82,000 more on your money. But yeah, that's that. In conclusion, time value of money is a very powerful concept that once you understand it, you can maximize the amount of return to get on your investments and maximize the spending power of your money, which at the end can help build your personal finance in addition to actually building your wealth over time. However, the opposite of time value of money is annuities, and the concept in a nutshell is basically equal payments over a stipulated period of time. And this is used for like institutions when they're issuing loans, or when we are paying mortgage and them something there. And typically loaning institutions normally use an amortization schedule, something like this. But I probably have to just leave that for our next video. Come to get my graded. So yeah. So once we get a grade, make a video on it. But for now, that is it, guys. Ensure you like, share, comment, subscribe, tell a friend, and yo, see you in the next video. Peace.